Good evening, everyone. Tyler Dagler here, Marshall Reddick. We will be getting started shortly, just giving it a minute for people as they are filing in. Talk to you guys soon. Thank you so much for being here. We appreciate your time. All right, good evening, everybody. It's 5 o'clock here, Pacific Standard Time, so we're going to go ahead and get started. Welcome, everyone, to our seminar this evening on how to use your IRA and 401k monies in order to invest in real estate. My name is Tyler Dagler. I work here at Marshall Reddick, and I am joined today by Dimitri. We're going to get started here, so let's give you just a real brief intro on who we are so you know who you're listening to. So Marshall Reddick Real Estate, we have a couple different services that we offer here. So we are a full service real estate broker. So we buy and purchase and sell real estates over many of the markets that we work in. We're also a property manager. So in the markets we work in where we help our clients purchase their real estate investments, we're also managing those investments for them. We currently manage just over 2,000 properties across all of our markets. So a lot of experience there. We do work in private money lending. So we help our clients lend out their money on loans where they sit as the first position lien holder and they earn a return through the interest. And we also have an investment fund. So for my accredited investors out there, it's a little bit of an umbrella program for private money lending where you invest into the fund and then the fund is lending money and you are earning a return on that. So this is me. Hi guys, I'm Tyler. It's a little bit about me. I am a realtor here in the Orange County market, currently sitting at about 22 million in volume. I went to Clarkson for financial analytics and I just finished up my negotiation mastery program over at Harvard. I look forward to speaking with all of you that I haven't spoken with already tonight. So here are the markets that we are mainly situated in. You can see we are spread out across the US, and these markets are not by chance. All the markets that we work in were specifically chosen based on the return that it brings our investors. Here's just a couple different things that we use to, going back to that, identify the markets that make most sense for our investors, right? So we're looking at the jobs market, we're looking at standard vacancy rates, diversity, affordability. Big one, landlord friendly. For those of you on the call who own in California, you know that this is not the most landlord friendly states, and that's why we have branched out into other states for our investors. So with that and a little intro about me, I'm going to bring in Dimitri here, and Dimitri's going to dive in specifically on how you guys can utilize IRA and 401k monies to invest in real estate. Dimitri?
Thank you so much, Tyler. Can you hear me okay?
I can hear you, sir. Thank you.
Okay, great. Well, thank you guys for joining tonight, and I'm excited about sharing this presentation with you. Every time I talk about this, I do get excited because it's very powerful strategies. And just wanted to piggyback on what Tyler said, and I'm a client of Marshall Reddick personally. I purchased investment properties, I lent money, I invested in a fund, and I think it's a great model for us to work together. So let me dive in. What we do here at Sense Financial, our mission is to help our clients obtain control and protect their retirement accounts. Proverbs 21:5 says, good planning and hard work leads to prosperity. And that's what we want to do. We want to come along your side and help you build wealth for the future. First, I'd like to give you an example of one of our clients and what we did for us. It's kind of a financial makeover, if you will, that I'd like to call this slide. So this is Jason, one of our old clients. He found us online. He had a couple different retirement accounts before he came over, an IRA and a 401k from his previous employer, valued at about $135,000. He was losing money in the stock market in his accounts. He was watching, just like maybe some of you, especially this year, if you're looking at your statements on your IRA or 401k and seeing 15, 20, 30% down, depending on what the investments you have, he was one of those investors that his balances were shrinking, actually, and he was concerned about with all the government spending that is going on, and it's continued to expand, that government potentially may come out and even tap into personal retirement savings. So he did some research, found us online, and we did set up a self-directed solo 401k for Jason, and he actually made a couple investments. He purchased a rental property in his market there in Florida. It's been a number of years ago, so at the time he was able to purchase a property outright with what he had. Certainly not the case now, but he did that. He also invested in his brother's business. His brother is a serial entrepreneur, and he started several businesses successfully, and this was his latest venture. It wasn't publicly traded company, so there is no way to invest your IRA money into a private business like this, but with the self-directed 401k, he was able to do that. And then the rest of the money he invested in a real estate note. Basically, his 401k became a bank. He is, or at the time, he was collecting about $1,000 a month in a cash flow, and his portfolio was growing. So if you compare what he had before with what he has now, his overall portfolio is growing every single month because he's receiving stable and predictable cash flow from a rental property and from a note, those interest payments. And the assets that he has, such as rental property and the business, those assets that do appreciate, he probably more than doubled his balance by now. So that's kind of before and after. That's what you can expect. So tonight I'm going to cover three options. So essentially there are three options when it comes to self-directing your retirement funds. There is a self-directed custodial IRA, there is a checkbook IRA, and there is a solo 401k. And I'll take a few slides to explain each one of those. But first, let me just give you or illustrate to you the difference between a conventional IRA or 401k that you have, which is held and controlled by the custodian. And a custodian has the power to control your investment choices. So if you're like most people, you have an IRA or a 401k, and custodian, the only choices that they allow will be confined to the stock market, stocks, bonds, and mutual funds. Here is just an example of a sheet that when I used to work for a company and had a company 401k plan, the representative from a company will come and meet with all the 401k participants about once a year, will give us a sheet similar to this one and explain the investment choices. So as you can see, there is just a handful of mutual funds to choose from. That's it. There is no other investment options that were available to us. Well, when it comes to self-directed IRA or 401k, your choices are virtually limitless. You can invest in residential real estate, tax liens, tax deeds, even cryptocurrency. been very popular in the last few years. You can invest in mortgage notes and trust deeds and on and on and on. So the list here on the right, you see just some of the most common investments. Certainly not exhaustive list. In fact, IRS doesn't give you a list of what you can do. It's actually the opposite. There is a couple things that you are not allowed to do or invest in, and I will cover that in an upcoming slide. But again, you have virtually limitless investment options with the self-directed account. So what is a self-directed IRA? It is a tax-deferred trust account that is held with the IRS-approved custodian. Every IRA requires that you have a trust company or a custodian who holds the funds, and they administer the investments for you. So the self-directed custodian allows you to invest in non-traditional assets. Most people not even aware that it is possible, but it has been possible since 1974. And this law was created under Internal Revenue Code Section 408 to help people like you and I to save towards retirement. So how does the self-directed IRA works? Well, first you need to open an account with the IRS-approved custodian. Step number 2, you will take your existing funds from your IRA or 401k or 403b or any other qualified retirement plan, and you do a qualified transfer. When you move funds from your existing retirement account to a new self-directed IRA, this will be a direct transfer, meaning you are not touching the funds, so it will not be a taxable event. Then at that point, you direct the custodian what you want to do. So you direct the custodian to invest in a rental property or do a private loan or any other investment. And all of the income from those investments must go back into the IRA custodial account, and all of the expenses that are related to the investment. For example, when you buy a rental property or when you own a rental property, you may have some repairs or you have to pay property tax bill or insurance bill. So all of those expenses must come out from the IRA account to pay for those. So the advantage is that you do have ability to invest in non-traditional assets, but custodian is in there to make profit, and disadvantage is every time you make a transaction, there is going to be a fee associated with that, because you have to go through essentially a middleman. That's the role of the custodian, because they're in between your IRA and yourself, so you always have to go through them. And not only that, but also you sometimes there are delays, and you can possibly even lose on certain transactions because custodians, they tend to drag their feet. Well, that's when the Checkbook IRA was created or designed, is to basically help those people who wanted to invest in alternative assets with their IRAs, but they wanted to have more control. And Checkbook IRA is also known as a IRA LLC or IRA owned LLC. So essentially what it is a special purpose LLC that is created with one purpose, to be owned by the IRA. So IRA owns it, IRA is the single member of the LLC, and you, the client, is the manager of the LLC. It does require IRS compliance setup and a IRS approved operating agreement, and this structure allows you to bypass the custodian when making the investments and transactions. You can't eliminate the custodian with an IRA. As I explained earlier, custodian is required for every IRA, but you can bypass them by using this structure. So let's take a look at the mechanics, how it actually works. Well, again, the first step is you have to open a new IRS-approved account with IRS-approved custodian that allows alternative investment and allows special purpose LLC. Then you will perform a qualified transfer, the same as in the first option. You move money or funds directly from your existing retirement account into the new account. You're not touching the funds. It's not a taxable event. Next step is a special purpose LLC that created. It's a single member LLC. Your IRA is the only member of the LLC and you are the manager. So as a manager, you control it. Once the LLC is created, you will instruct your custodian to buy 100% of the LLC units and essentially transfer all of your cash from your IRA into the LLC checking account. And from that, you are the only one who's in control of this. You will open a bank account in the name of the LLC using LLC EIN that we will obtain from an IRS. And then you're the one who making the decisions as when it comes to investments. You will buy the investments on behalf of the LLC. You will decide if you wanted to invest in a private loan or fund a note and things like that. And you actually the one who's writing a check. You no longer have to go through a middleman. You actually have direct access to your funds and can make investment or handle the transaction as simple as writing a check. Now, likewise, all of the income from the investments must go back into the LLC checking account. And all of the expenses related to the property must go back into the or must be paid from the LLC checking account. The only difference is that you're writing the check. There is no middleman. You don't have to submit requests to the custodian to pay certain expense or make the investment. You do it directly. So as you can see, this is a much more powerful option, gives you the control, allows you to bypass the custodian. And then the next option is a solo 401k. It is also known as the ultimate retirement plan. It's not a new plan. They've been around for quite some time, designed under Internal Revenue Code section 401 subsection K. That's where the name comes from. And it's designed specifically for those people who are self-employed or own a small business without full-time employees. That's where the definition solo comes. So typically it's there is just one participant, sometimes maybe two participants, a husband and wife, if they're both in the business, or maybe two partners in the business. That's also not uncommon. The increased interest in these plans was as a result of changes in the tax law in 2002 that made all the benefits that are currently available possible. And I'll go over them in just a moment here. But first, let me explain the eligibility. So you have to meet two criteria. Number one, there must be a presence of legitimate self-employment activity. Self-employment activity can be in any shape or form or type. Just a few examples here: a real estate agent or a consultant or a doctor who has a private practice or attorney who has a private practice, or maybe you just flipping a house or two on the side, or maybe again you have a full-time job but you do some consulting on the side. That also will work. And number two criteria that you must meet to qualify for a solo 401k is the absence of full-time employees. You cannot have non-owner employees working more than 500 hours a year for you to qualify for this plan. So really the only thing that could disqualify you from having this type of plan is having a business with full-time employees. Because if you don't have a business, you can start one, but if you have a business and you have employees, then you will not be eligible, unfortunately, for this program. So how does it work? It's even simpler and more efficient than the previous structure that I showed you. So number one, you have to have a plan sponsor, that self-employment activity or business. And you don't have to have a LLC or a corporation set up. If you do, great. If you're just working for yourself as a sole proprietor, that's all you need. You need presence of legitimate self-employment activity. So next, as a sponsor of the plan, you will adopt a 401k plan the plan and trust are created. The trust is the vehicle that used to hold the plan assets. Instead of using a custodian, third-party custodian, here we're going to create a trust specifically for your 401k plan that you as trustee control. So a trust is a separate legal entity with its own unique name, its own tax ID number, and as a trustee, you control that. Similar that you control LLC as a manager. Here, it's a 401k trust. As a trustee, you control. As a trustee, you will open a business checking account in the name of your 401k trust using a trust tax ID number, and then you make the decisions when and how to invest those funds. Likewise, all of the income must go back to the trust 401k trust bank account. All of the expenses are paid from the 401k trust bank account, and you as the trustee control the account, so you can take care of those items as simple as writing a check. The benefits of the solo 401k: number one, it has a high contribution limit. $63,500 for the last year. Actually, I need to update this slide. For this year, the numbers have gone up even to $67,000. Also, next feature is the loan feature. If you have a 401k plan, similarly to plan that you may have or used to have at your employer that you could borrow from, you can take a personal loan, you can borrow from a solo 401k up to $50,000 or 50% of the balance, whichever is less. So it's a nice feature, not to abuse it, because remember, you're borrowing from your own retirement account. It's not that you borrow against it, you borrow from your 401k, so you're actually depleting the capital. But it's a nice feature to have should you really need the cash. Because if you have an IRA, the only way to access that is to take a distribution, which will be a taxable event, and on top of that, you have to pay penalties for premature distribution. Here with the solo 401k, you can take a loan which is tax-free, penalty-free. You just have to pay interest back to your own 401k. Next, with the solo 401k plan, you have the ability to have Roth sub-account or make Roth contributions. And you can contribute up to $26,000 into your 401k Roth sub-account. Compare that with $7,000 in a Roth IRA, which is also subject to income limitation. If your income is over a certain threshold, you will not be eligible to contribute to a Roth IRA. Or with solo 401k, Roth contributions can be made regardless of your income. Next, you have a checkbook control, and it's very cost effective. There is no transaction fees, there is no asset-based fees. You just pay a small nominal fee to maintain the plan IRS compliant, and you're in full control. Because there is no custodian that is required. You, the client, become the trustee of the plan, and you control that. And this plan also allows your spouse to participate. If spouse is also involved in the business and receives compensation from the business, your spouse can also participate. So essentially, you double the benefits. And last but not least, it is exempt from UDFI, which is unrelated debt finance income. In an IRA, if you use leverage to buy a rental property or investment property, a portion of the income that is derived from the leveraged portion of the property will be subject to UBIT, which is unrelated business income tax, but 401k is exempt from that. So just another reason to use a self-directed solo 401k to buy investment properties with leverage. So the bottom line, self-directed allows you to have a full diversification. Credit for this cartoon goes to my daughter. A number of years ago, she was helping me, and she made this cartoon, a man holding a basket with all the eggs are broken because the bottom fell off. The basket represents stock market, and wife says, I thought that our investments were diversified. Well, guess what? If you're investing in just one asset class, then you don't have a true diversification. Ecclesiastes 11:2 says, divide your portion to 7 or even to 8, for you do not know what misfortune may occur on earth. So it's just a wise thing to diversify. So by diversifying, you can actually minimize your risk. Self-directed also means unlimited investment choices. You can invest in precious metals, residential real estate, commercial real estate. You can do hard money lending. You can invest in trust deeds, in private businesses, tax liens, and more. The endless options for investments. So let's talk about some of the limitations or what the prohibited transactions are. And they're defined under Internal Revenue Code section 4975. And the rule says that your retirement account cannot invest in collectibles, and collectible can be artwork or coins or collectible stamps, anything that is considered collectible. You cannot invest in an S corporation. If you own an S corporation, you can set up a 401k, by the way. You just cannot invest your 401k money into another S corporation, somebody else's S corporation. And you cannot invest in life insurance contracts. In addition to that, this section defines disqualified person and prohibits disqualified persons to be involved in any transaction with retirement account. And the disqualified person is the account owner, so yourself, your spouse, your ancestors, and linear descendants. Their spouses, also investment advisors, and any fiduciaries, those that are providing services to the plan. And also any business entity in which any of the disqualified persons have 50% or greater interest. So the easy way to remember this is a vertical line. So if you look at yourself and draw a vertical line, so yourself, your spouse, your parents, grandparents, your kids, grandkids, and their spouses. That's a vertical line. The extended family members, such as your siblings or your nephews or your cousins or uncles, and further, those are not disqualified. So you can still conduct a business using your IRA or 401k with those extended family members. And now let me give you some examples. The prohibited transaction rules is define any transactions. And the key here, direct or indirect transaction. It can be a sale, exchange, or leasing of a property between a plan and a disqualified person. Sometimes a question comes up, I do own a rental property. Can I transfer that to my self-directed IRA or 401k? Well, you can just transfer it, but there needs to be a transaction. So basically, can your 401k buy the property from you? And the answer is no, because you are a disqualified person. And there is no transaction that is allowed between the disqualified person and the plan itself. So that will not work. Lending money or extending credit between a plan and disqualified person. That's a reason why you cannot get a conventional mortgage, because you cannot guarantee the loan or extend the credit otherwise to the plan. You can use leverage, but the loan has to be non-recourse. And that's where Marsh Ready comes in, because they do offer loans like this. They offer private lending. Next is providing any goods, services, or facilities between a plan and disqualified person. An example of that will be if you are a handyman and you buy a rental property in your IRA, you cannot do the work on the property. If you're a real estate agent and you buy a property in your solo 401k, you cannot represent the 401k in a transaction, regardless whether you get paid or not. next, transferred to or used by or for the benefit of a disqualified person of the income or assets of the plan. So a good example is you buying, actually I spoke with somebody today, somebody who, a client, existing client of mine called me up and just wanted to check with me about potential investment he wanted to make, and they actually wanted to buy a vacation rental and do the Airbnb type rental and that. And you actually personally cannot stay in that property. You cannot do any work on the property. And he said that won't work for him because they were planning on staying on that. Well, if your 401k owns the property and you're a disqualified person, you'd be benefiting from the asset of the 401k, which is prohibited. Next, any act by a disqualified person who is a fiduciary where he deals with the income or assets of the plan for his own interest. So if you receive an income from the investment of the 401k, you can personally benefit from that. You can deposit that into your personal checking account. The 401k must get 100% benefits from that investment, and you cannot get any benefits from that. And finally, receiving any consideration for your own personal account by any disqualified person, which is yourself again and your immediate family members, in connection with any transaction. Example again will be being a real estate agent and getting paid on the transaction. So that will be a double prohibited transaction, being a real estate agent. Number one, you're providing a services or service to the plan, which is prohibited. And number two, you're receiving consideration, you're receiving commissions from that transaction, which is also prohibited. Next slide, purchasing real estate inside of your IRA or 401k is fairly straightforward. The benefits is that real estate income and gains generated inside of your retirement account are tax deferred or tax free. In case of a Roth, you'll be paying taxes at a future date rather than in the year when the investment produces income, which allows you to grow your investment much quicker because you have more money to work with. Real estate gains and income inside of Roth will be tax free for the rest of your life, and all the income must go back to the 401k or an IRA account, and all the expenses must be paid from the IRA or 401k account. As I mentioned, it is possible to finance the property inside of your retirement account, but you cannot provide a personal guarantee. Therefore, loan must be non-recourse. And non-recourse means that there is no personal guarantee. The lender doesn't have any recourse against you personally. The property is the only security for the loan. So that's what the non-recourse means. Typically, these loans require 30 to 50% down. Property must provide sufficient cash flow to pay for the debt service. You must have reserves. Typically, lender will ask 10% for reserves. And if you use the leverage inside of an IRA, it will trigger UDFI, which is again unrelated debt finance income, which is subject to UBIT or unrelated business income tax. There is only a handful of lenders, including Marsh Reddick, that offer this kind of loans, and we do have a list on our website. Just a quick summary or a quick side-by-side comparison between the three options. So all of them, the custodial IRA, the checkbook IRA or checkbook IRA, and the solo 401k allows you to invest in non-traditional investments. You do need a custodian with an IRA, which is an additional cost. You don't need a custodian with the 401k. There is no custodian, so no cost associated with the custodian. You get the checkbook control with the IRA LLC and the solo 401k as well. the transaction fees are applicable with the custodial IRA or just a normal self-directed IRA. You eliminate transaction fees with the custodial, with the checkbook IRA, and there is no transaction fees with the solo 401k either. You can only borrow from a 401k. There is no option to take a loan from an IRA. An IRA is subject to UBIT if there is leveraged real estate. The contribution limit with a 401k is almost 10 times higher comparing to an IRA, which is actually one of the main benefits why people do that. So if you're self-employed and or maybe you own a business, and the more income you make, the more taxes you're going to pay. So this is a great way to minimize your tax liability, because potentially if you're a husband and wife team working together, you can shelter over $120,000 of your income from taxes. I mean, think about the bottom line. The tax savings can be huge, because you're probably going to be able to bump yourself down into a lower tax bracket by sheltering that much income from taxes. So you're going to be paying in a lower tax bracket and a much smaller amount. So savings can be huge, and if you multiply that over the years, it's going to be life changing. Solo 401k is the only account that allows you to have a built-in Roth account. For an IRA, you need to have a separate account because it's either traditional or a Roth. With the solo 401k, you can have multiple accounts within the same plan. And but solo 401k is not for everyone. It's the most powerful of the three, but it's not for everyone. Self-employment or business is required. Now, I'm approaching the end of my presentation, and because of the limited time, I had to, kind of fly over it. But we'll try to get to some of the questions, to cover some of the questions that perhaps came up. And if I did not address a question that you perhaps were hoping I can address, you can type your question in a chat box there and in your control panel, so that we can address as many questions as we possibly can. I'm going to be turning this over to Tyler in just a minute here, but so while he's talking and while we're doing this transition, you have a few minutes to type your questions, so I encourage you to do so. But regardless, everyone's situation is unique, and I do offer a free consultation to everyone who is on this webinar tonight. I do offer a 15-minute complimentary consultation, and you can actually book it just by going to our website. Here is a direct URL, or you can also find the link just on our homepage, sensefinancial.com. It takes about a minute to book the call. You can pick the day and the time that is available to you, and it's the availability is shown in real time. And I certainly look forward to speaking one-on-one with you and just answering your questions and brainstorming with you what the best solution for your retirement savings will be. This is my contact information. This is a number of our office and my email. Feel free to shoot me an email with your questions as well, but usually it's more effective just to do a phone consultation. All right, that will be my part. I know Tyler will have a couple more slides to go over. Tyler, I'm gonna turn it back on to you.
Thank you for that, Dimitri. That was a lot of really awesome information. We really appreciate it. Got a couple slides here, and we did have a couple questions come through, so I will bring those up. But just want to touch base on a couple things here. So, with Dimitri's help and guidance and expertise, wisdom and knowledge, we help dozens of our investors each and every month utilize their IRAs and 401ks in order to purchase investment real estate. It's a really powerful tool. And this is a really powerful tool here that we wanted to make sure you guys know is available to you. So this is our property rating ebook. This is something that we wrote. It's proprietary to us. And what it does is it helps clients understand how to rate investment properties in particular cities. Looking at the metropolitan statistical area prices of homes, we can determine based on the thousands of properties that we manage currently, which classes in different cities are going to make most sense and provide a better ROI. So we just wanted to make sure that you guys knew that this was here available for you for free. It's about a 40-page read. It's an easy one, but it's got a lot of good data in there if you like to dig into this stuff like we do. Right, and so just going back to like what Dimitri said, we are here for consultations whenever you guys need them, and this is kind of how they go, right? We'll sit down and talk about your goals. People don't typically buy real estate for no reason. There's a end in sight that they're looking to accomplish, and so by understanding that, we can help you evaluate your options, decide what time frames make most sense for you, and then help you set your criteria, identify markets, and then we get you involved with the team and we can help you accomplish those. And we really truly enjoy doing it and look forward to helping everybody here on the call accomplish those. Here's my contact information. Please feel free to reach out for me at anything at all. This is my personal cell phone number. You can call, text, email me. The only time I'm not going to respond is when I'm sleeping. Besides that, I'm working on real estate. It's all I do. And I really enjoy it and be happy to help you guys. So Dimitri, we did get a couple questions here, and I'll read them out. And if you could address them for the people on the call, that would be really appreciated. So one question was, can personal money be combined with IRA or 401k money in order to purchase real estate?
Yeah, very good question. It comes up every so often. It's possible under certain circumstances, but it's not always practical. Because remember, you are a disqualified person, and you have to look for at the reasons why do you want to combine the IRA money with your personal money. We don't have that detail in the question, and usually in most cases the reason people want to combine because maybe they have 50 grand in an IRA and they have 50 grand in savings, and they don't have enough in savings to purchase real estate, so they want to combine that with their IRA. And that will be, you essentially will be using your IRA to enable yourself purchase an investment that you otherwise will not be able to do, and that will be a prohibited transaction. Again, it might be possible if you don't have to rely on your IRA to buy that property, you have enough funds, you just want to combine it. It's possible. But again, that will be a good question to discuss during the one-on-one phone consultation, so that we can so that I can understand fully the details and then maybe give you a better recommendation.
Yeah, that makes a lot of sense. Okay, awesome. Thank you, Dimitri. And one last question that we had from the panel here. We've got a client on the line who has multiple Roths and a 401k. He wants to know if he is able to combine all of these in order to purchase investment real estate.
Well, you certainly can combine multiple Roth IRA accounts into one. Yes, that's possible. But if you also have a pre-tax funds, those cannot be combined with a Roth. Because remember, Roth is a post-tax. You already paid the taxes on the Roth funds, and the traditional IRA is pre-tax. So you can't combine them into a single account. You can roll over your Roth IRA into a self-directed Roth IRA, and you can roll over your 401k or a traditional IRA into traditional self-directed IRA, but it will be two separate accounts. Again, it will be possible to combine both accounts to purchase a single investment property, but you cannot combine Roth money and pre-tax money into a single account. That's not possible because it's two different types of money, and you got to track them separately.
Understood. So it sounds like that you can self-direct multiple accounts, maybe just not put them all under the same LLC.
Well, again, you may or may not need the LLC. The bottom line, you will need the self-directed accounts for each type, whether it's a Roth or a traditional. So if you want to use your traditional IRA funds and Roth IRA funds, you will need a self-directed traditional IRA and you will need a self-directed Roth IRA. Now, from there, the strategy may be different. It's possible to set up a two-member LLC where you have checkbook control over all of those funds. That's a possibility. But again, the bottom line, you will need a self-directed Roth IRA and you will need a self-directed traditional IRA.
Excellent. Dimitri, thank you so much for your time and your wisdom. Our clients really appreciate it. And thank you everyone for taking the time out of your day to come listen to us speak about this awesome tool. I made a round of calls to everybody beforehand on this to get any questions, and I will definitely be following up with everybody in the following days to make sure that you got everything that you were looking for. And we hope to work with all of you and help you guys accomplish your real estate goals. And again, please don't hesitate to reach out for anything at all. Everybody have a wonderful night. Thank you again, and we'll talk to you soon.
Thank you for joining, everyone. Have a good night.